Have you ever wondered about the secret behind the success of Ray Dalio's all-weather portfolio? Today, we're going to explore this financial phenomenon, a brainchild of one of the world's most successful investors, Ray Dalio, the man who founded Bridgewater Associates, one of the world's largest hedge funds. This portfolio has been designed with a simple yet powerful aim: to provide robust returns in all market conditions. The all-weather portfolio, as the name suggests, is a portfolio that is designed to perform well in all economic environments. It's like a sturdy ship that stays afloat and sails smoothly, whether the waters are calm or stormy. It's not about chasing the highest returns in good times, but about achieving consistent, healthy returns over time while minimizing the risk of major losses. In essence, it's a medium-risk portfolio, constructed with a blend of different asset classes, tailored to weather any storm. Over the last 30 years, this portfolio has achieved a compound annual return of 7.33%, proving its resilience and effectiveness. But what makes the all-weather portfolio stand out? It's not just about the mix of assets, but also about the unique strategy and philosophy that underpin it. The portfolio is exposed to 30% on the stock market and 15% on commodities, a balance that has proven to be effective in navigating various market conditions. The portfolio's asset allocation, its historical performance, and the wisdom behind its construction are all factors that have contributed to its success. But it's also about the mindset of the investor, the ability to stay the course, and the discipline to stick to the strategy, even when the going gets tough. So let's dive in and unravel the magic of the all-weather portfolio. Stay tuned as we delve deeper into its composition, its performance, and the advantages and downsides of this remarkable investment strategy. We'll also share key takeaways that you can apply to your own investment journey. Let's embark on this exciting financial voyage together. At the heart of the all-weather portfolio's success is its unique composition. This portfolio isn't merely a hodgepodge of investments thrown together. Instead, it's a carefully designed array of asset classes, each playing a crucial role in ensuring the portfolio can weather any financial storm. So, what exactly makes up the all-weather portfolio? Firstly, it contains a 30% allocation to stocks. While this may seem underwhelming compared to more traditional portfolios, it is purposeful. The reduced exposure to stocks mitigates the portfolio's vulnerability to market volatility, providing a safety net during economic downturns. The portfolio is also 15% invested in commodities. Now, commodities might not be the first thing that comes to mind when you think of investing, but they play a pivotal role in this portfolio. They provide an effective hedge against inflation, helping to maintain the portfolio's purchasing power during inflationary periods. But the all-weather portfolio doesn't stop there. The remaining 55% is distributed across various other asset classes. This includes long-term and short-term bonds, gold, and even a dash of other alternative investments. Long-term bonds make up a significant portion of the portfolio. They offer stability and act as a counterweight to stocks, performing well when stocks underperform and vice versa. Short-term bonds, on the other hand, provide income and liquidity, allowing the portfolio to generate cash flow and to rebalance when necessary. Gold, a time-honored safe haven, is another key component. It serves as an insurance policy, protecting the portfolio against severe market downturns and geopolitical uncertainties. Lastly, the inclusion of alternative investments offers an additional layer of diversification. These can range from real estate to private equity, and they help to further spread the risk and enhance potential returns. As we can see, this portfolio is not just about stocks and bonds. It's about diversification and balance. It's about creating a mix of assets that can perform well in all economic conditions, hence the name all-weather. This unique composition is what sets the all-weather portfolio apart, and it's the secret behind its ability to consistently deliver solid returns with reduced risk over the past 30 years. Now that we know what the all-weather portfolio is made of, let's understand why each component is crucial. The all-weather portfolio is like a well-tuned orchestra, where each instrument or asset class plays a key role in creating a harmonious performance. Each component contributes to the portfolio's ability to weather various economic conditions, hence the name all-weather portfolio. Let's delve into why each asset class is so important. First off, we have stocks, making up 30% of the portfolio. Stocks are critical as they offer the potential for high returns over the long term. They provide the growth engine of the portfolio, but they also bring volatility. This is where the genius of the all-weather portfolio comes into play. It balances the risk associated with stocks with the stability of other asset classes. Next, we have commodities, representing 15% of the portfolio. Commodities, like gold and oil, can act as a hedge against inflation. When inflation increases, commodity prices often rise, helping to offset the potential negative impact on other assets. Then we have the bond portion. With a significant allocation to both long-term and medium-term bonds, the all-weather portfolio seeks to provide steady income and act as a buffer during periods of economic downturn or stock market volatility. Bonds are generally less risky than stocks and can help smooth out the portfolio's overall performance. Now let's talk about the role of cash. While it might seem counterintuitive to hold cash in an investment portfolio, it serves an essential purpose. Cash provides liquidity, which can be particularly useful during market downturns. It also acts as a buffer against volatility and provides a source of funds for rebalancing or taking advantage of investment opportunities as they arise. Lastly, let's not forget about the correlation between these asset classes. Correlation is a measure of how different investments move in relation to each other. When asset classes are perfectly correlated, they move in the same direction at the same time. However, the assets in the all-weather portfolio are not perfectly correlated. This means that when one asset class is performing poorly, another might be doing well. This lack of perfect correlation helps to further diversify the portfolio and reduce risk. In conclusion, no single asset class in the all-weather portfolio is a superstar on its own. It's the combination of these asset classes and the way they interact that make this portfolio unique. It's designed to perform well across a variety of economic conditions, hence the term all-weather. Each component of the all-weather portfolio plays a vital role in its overall performance. The key is not just the components themselves, but the balance between them. This balance is what allows the portfolio to weather any economic storm, providing stability and growth opportunities for investors. Of course, the most important question is, how has the all-weather portfolio performed over the years? The performance of the all-weather portfolio is indeed impressive, and it lives up to its name by weathering the storm of financial market fluctuations and delivering consistent returns. Let's delve into the details of its performance over the last 30 years. Over this period, the all-weather portfolio has achieved a compound annual return of 7.33%. This means that if you had invested in this portfolio 30 years ago, your investment would have grown by an average of 7.33% each year, compounded annually. For instance, a $10,000 investment would have grown to over $76,000 even without adding any additional investments. This return is remarkable, especially when you consider that it has been achieved with a standard deviation of only 7.43%. Standard deviation is a measure of how much the returns of the portfolio vary from the average return. A lower standard deviation indicates less variability or volatility in the portfolio's returns. Therefore, a standard deviation of 7.43% demonstrates that the all-weather portfolio has provided steady and predictable returns over a long period. In other words, the all-weather portfolio has not only generated robust returns, but it has done so with a relatively low level of risk. This is one of the prime reasons why the all-weather portfolio is a popular choice among investors who seek consistent returns with moderate risk. Let's also not forget that in 2023, the all-weather portfolio granted a dividend yield of 2.46%. This is the income that an investor receives from the portfolio's underlying investments, expressed as a percentage of the portfolio's value. This yield adds to the total returns of the portfolio, thereby enhancing the overall performance. While the all-weather portfolio's performance might not seem extraordinarily high compared to some other investment strategies, it's important to remember that it's designed to provide steady returns in all kinds of market conditions. It's not about hitting home runs, but about consistently getting on base. This is what makes the all-weather portfolio a reliable investment strategy. In conclusion, The all-weather portfolio's performance over the last 30 years is a testament to its effective asset allocation strategy. This strategy has enabled the portfolio to deliver consistent returns with moderate risk, making it a suitable investment option for a wide range of investors. Despite market fluctuations, the all-weather portfolio has consistently delivered robust returns. Like any investment strategy, the all-weather portfolio has its pros and cons. Let's dive into them to give you a clearer picture of this investment approach. One of the key advantages of the all-weather portfolio is its diversification. By spreading investments across a variety of asset classes, the portfolio aims to reduce the risk of severe losses. This diversification isn't just across different types of investments, but also across different economic environments. The portfolio is designed to perform well in all sorts of weather, hence the name. Another advantage is its stability. Over the last 30 years, the all-weather portfolio has shown a relatively consistent performance. It has achieved a compound annual return of about 7.33%, with a standard deviation of 7.43%. This means that the portfolio's returns have generally stayed within a predictable range, providing investors with a sense of security. Moreover, the all-weather portfolio can be implemented with common ETFs, making it accessible to a wide range of investors. You don't need to be a Wall Street whiz or have a hefty bank account to get started. But of course, the all-weather portfolio isn't without its downsides. One potential pitfall is that it can underperform in booming stock markets. The portfolio's emphasis on stability and risk reduction means that it may not fully capitalize on the high returns that can be obtained during market upswings. Another downside is that the all-weather portfolio may not be suitable for investors with specific financial goals or risk tolerance levels. It's a medium-risk portfolio, so it might not align with the objectives of those seeking high-risk, high-return investments or those needing a low-risk strategy. Lastly, while the portfolio's diversification is generally a strength, it can also be a disadvantage in certain situations. For example, if one asset class significantly outperforms others, the portfolio's widespread can dilute the impact of that high-performing asset. In conclusion, the all-weather portfolio offers a balanced approach to investing, aiming to provide steady returns across different economic climates. However, it's not a one-size-fits-all solution. It's crucial for investors to consider their individual financial circumstances, goals, and risk tolerance when deciding if this portfolio is right for them. The all-weather portfolio may not always outperform the market, but it's designed to weather the storms. So what can we learn from the all-weather portfolio? Well, for starters, the unique composition of this portfolio is a noteworthy aspect. It's built with a medium risk approach and can be implemented with 5 ETFs. This configuration, which includes 30% exposure to the stock market and 15% to commodities, is designed to weather all financial climates, hence the name. We also highlighted the historical performance of the all-weather portfolio. Over the last 30 years, it has achieved a compound annual return of 7.33%, with a standard deviation of 7.43%. This shows us that the portfolio has not only provided consistent returns but also managed risk effectively. In terms of advantages, the all-weather portfolio's diverse asset allocation is certainly a strength. It's designed to perform well regardless of the economic environment. This can be particularly useful for investors seeking stability and predictability. But it's also important to remember the downsides. For instance, there may be other portfolios with higher returns and less severe drawdowns, and the all-weather portfolio may not always outperform during strong bull markets. Additionally, we discussed some key concepts like drawdowns, rolling returns, and correlation measures. Understanding these terms can help investors make more informed decisions and manage their portfolios more effectively. And finally, we explored how the all-weather portfolio can be used in the context of early retirement management and how it granted a 2.46% dividend yield in 2023. Whether you are an investor looking for a balanced portfolio or simply curious about investment strategies, the all-weather portfolio offers valuable insights. This portfolio, developed by Dalio, provides a practical example of how diversification and strategic asset allocation can help investors navigate various market conditions while managing risk and delivering consistent returns.